good afternoon, lady and gentlemen. Welcome to the Super Review NAB Roundtable, dealing as an opening stance anyway on post-retirement policy and incomes, and the fact that it represents a challenge for a lot of superannuation funds, which I know MTAA Super has addressed, and I think Paul as well has been having a nice long hard look at how Club Plus deals with it. So something everybody I think has mentioned in passing so far is that the settings, the policy settings, let's be fair, the tax settings are problematic. They don't really encourage people to do much more than what Russell has just outlined, which is to take your lump sum and then go and rely on the pension. So what has to change? What does the government, and indeed what does the industry have to do to actually get people focused on, post-retirement in a way that says that they should be taking more responsibility for that, and that basically taking a lump sum and then relying on the age pension it really isn't the ultimate option? I'll kick off with Anthony because he seems to have thought this through pretty solidly.
I think is it the carrot or is it the stick is the question for the government, because you've really got to wonder about the long-term sustainability of tax-free at 60. It truly is. It was a remarkable bit of policy back in 2007, whenever it was that Costello announced that. And probably, in talking to people and looking at other systems, we are the only system, to my knowledge, that relieves income from pension or superannuation streams over 60. And you can get private income from the top of my head from sources other than superannuation or pension up to 80,000 a year anyway before it's taxable as a 60-year-old fully retired individual. That is remarkably generous. So, if the government's going to provide tax incentives to encourage people, or incentives to encourage people to preserve a nest egg, well, they can do it negatively by taxing that nest egg, or they can change some other rather generous tax regime to provide incentives to preserve the nest egg. And frankly, I don't know. I mean, you need to do the modelling to work it out. That's an economic proposition that's a bit beyond my capability, but I think it has to be a combination of carrot and stick.
Or they could make it mandatory. And at the end of the day, the success of our current superannuation system, like it or not, is mandatory super. And just as people had a tendency not to save for superannuation until it was mandatory, I tend to think unless we make the post-retirement rollover over a certain balance mandatory, or mandatory to prefer a deferred annuity, people won't. People will not want to run the risk of them losing money in death, if that makes sense, and lose some of that bequest to the children. So my personal view was that if you have a balance over a certain amount, and I'm sure the economists can model it better than, and actuaries could better than I can, but over a certain amount, X% has to be rolled over or put into some sort of deferred annuity or pooling arrangement to cover the longevity risk. That way we're not disadvantaging those with low balances. They can still rely on the age pension, but those with higher balances need to fund themselves fully in retirement.
In many instances though, those with the large balances do put a bit of forethought into it and do think about that. We have this sort of magic number, and it's 10 fingers, 10 toes thinking, that under $100,000, I'll just grab the lot. I'll take it and I'll do what I want with it. Basically, you see that in the funds we run, we see them every week. People retire and they go, thanks, I'll have that. And rightly, it's not big enough to make a material impact in their retirement. But the funny thing we also see is that in retirement, people really need to hold those balances instead of taking them out and disposing of them relatively quickly, because the biggest cost in retirement is healthcare. And in many instances, people don't really give that much forethought to the effect that I might be 65 now and I've retired and I'll take my $100,000 and I'll buy a car and go on a holiday and do all that. And in 5 years' time, they're having to rely on the public healthcare system to deal with any ailments they might have. And in so many instances, you want to say, look, if you just left your money alone, drew it down as in a drawdown phase, you'd have sufficient capital to deal with those sort of issues. But people, again, don't think that far in front of all the issues that they're going to contend with in retirement.
And on that very good note, we'll call it quits there. So thank you very much.
Thank you,
Leanne,
Mike.
gentlemen, it was very good. Thank you.